But let's move on now. L&T Finance is on our radar. For Q1, their net profits saw a healthy growth. The margins are at a record high, while the return ratios have also improved. Sudipta Roy, who's the MD and CEO of L&T Finance, joins us now to discuss more on their Q1 performance and the business outlook. Sudipta, thanks so much for joining in. I want to start by asking you, what exactly is the AUM growth? Because retail loans now form over 95% in your AUM. By when do you expect the retail AUM to be about 100%?
See, currently the retail AUM growth has been about 31% on a year-on-year basis. But, and what the wholesale assets that we have left, in fact, we have put it on in an analyst deck, which is about 4,400 crore odd. Most of it is standard assets, and we are not in a hurry to pay it off. So as you can see, the pace of the wholesale deleveraging has been slowing down with every passing quarter, and we are left with sort of the bottom tail 5% of standard assets, which we will sort of pair off only if we get a good value for those assets. Otherwise, we'll let these assets run the course of their amortization schedule. So from here on, I think, it'll be a gradual growth in retailization. But we do expect that over the next about 4 to 6 quarters, we'll be inching close to that 100% mark.
Okay, all right. Hi, Sudipta. Thanks a lot for joining in. So your retail assets moved to around 100% from around 75%, I think, just around 4 quarters or so ago. What about the absolute AUM growth that you're looking at? If you could, reiterate that number. And also, what is the NIM guidance from here on? How is the cost of borrowing? And how do you see yields panning out as well, which impact your NIMs?
So first, I will take the NIM part. So NIM, we have been guiding that our NIMs plus fees will try to maintain at about 11% odd. If you see, our NIM this quarter hit about 9.31%, and our fees were about 1.7% odd. So, overall, we are at about 11.08%. So there has been a slight degrowth in NIMs and fees compared to last quarter, because last quarter we had a one-off insurance income impact. So more or less, our guidance is that we'll try to sort of maintain the NIMs plus fees at a sort of an 11% plus positive range. And as our wholesale book has been pairing off, our NIMs have been improving, and we have been seeing that trajectory of improving NIMs. In terms of overall asset guidance, you can see that after a long period of time, our overall consolidated AUMs have started growing, because at one point we were degrowing our wholesale balance sheet much faster than we were sort of growing our retail asset side of the balance sheet. And you can see that on an average, we are adding about anywhere between, 4,500 to 5,000 crores of AUMs, depending upon retail AUMs, depending upon the quarter. So for the year, on an average, you can say, AUM addition between 18 to 20,000 crores is what we are looking at. We are hopeful that by the end of the year, we will probably cross about 1 lakh to 1,05,000 crores of AUMs on the retail side.
Got it. The pleasant surprise was the collection efficiency in the MFI side of things. I think it was around 99.7% odd, which brings us to the question on asset quality. That's been improving. The gross NPAs have come down as well, from northwards of 4.5% to that mid 3.5% odd. Where does this number move in the time to come?
So see, our focus is on making our asset quality very, very stable. And as you rightly pointed out, especially in the MFI sector, our asset quality remains very, very stable. We are overall at around 99.7% sort of collections efficiency. And, in some markets, we are actually at 100% collections efficiency. So our asset quality has actually remained very stable on that side. In fact, what we are focusing right now, on a steady state basis, we would like to sort of give a credit cost guidance of anywhere between 2 to 2.5% right now. And over a period of time, we would like to move it even southwards. And because of our focus on bringing down credit quality, we launched something which is probably one of the first pioneering moves in the industry, where we have built a sort of a 3-dimensional credit engine which we call Cyclops, which actually does bureau, which actually does account aggregator based liabilities data underwriting, as well as something which we call alternate signals or trust signals in one pass. And we have now deployed it on our two-wheeler business. Now, overall, this is an omni-credit engine. We'll deploy it across all our other lines of businesses by the end of Q3. And overall, on the long term, we would want to bring our business, all our business. And when I talk about long term, I talk about 4 to 6 quarters, because, there is some reorientation and fine-tuning of the throughput as well as the output metrics from a credit cost perspective, which is being undertaken. But overall, on the long-term basis, we would like to sort of trend our credit cost to about overall 2% level.
Okay, to about 2% level on a long-term basis. Mr. Roy, good morning. On return ratios, could you provide us with a guidance on return on assets, return on equity?
So see, our overall Lakshya guidance is between 2.8 to 3% exit FY26. If you see this quarter, we are at about 2.68. So we are like sort of trading very close to that 2.8 percentage, which has been our guidance for exit Lakshya FY26. Now, obviously, we will continue to sort of fine tune our business metrics. However, this quarter and over the next couple of quarters, we might see cost of funds increase by about 15 to 20 basis points, which might take it closer to 80, sort of 8% odd. However, we are working to sort of improve our sort of cost efficiency metrics, our credit cost metrics, as well as our overall yields, because in certain businesses we are working around to push up our yields, especially in our two-wheeler business as well as our home loan businesses. So overall, our guidance is that we would like to hit that 2.8 to 3% number in sort of near exit FY26 is what we are targeting at. We will try to hit it earlier, but as of now, our guidance is exit FY26 will be within that 2.8 to 3% range. And in terms of ROE, if you look at the current ROE, we are at about 11.58%. Our target obviously is 15%. We are quite sort of, probably we have a little more capital than we need right now. But the fact is that given our growth sort of trajectory, we are very confident that in the next couple of quarters, our ROEs will also start creeping up. And as the balance sheet builds, that ROE will move towards that 14 to 15% range. So that is what our sort of long-term targets are. But on the exit FY26, 2.8 to 3% is the ROE guidance, and we remain focused on achieving that.
And this 14 to 15% on ROE by when?
It will take a little more time, I guess, because the fact is that the balance sheet has to build. So I would say that we were looking at anywhere between the next 8 to 10 quarters is what we are looking at.
Got it. All right. Because for FY26, most on the street are building low teens. So that's why I asked you. So maybe that'll take a little longer time to get it to the mid-teens. A quick word on the urban and rural mix of your book. I think currently it's around 70-30% odd. Tell us, how do you see this panning out and growth estimates for both?
Actually, in terms of disbursements, it's almost like 50-50 right now. And so if you look at our rural business finance, there are two main businesses on the rural side. There are rural business finance as well as tractor finance. And on the urban side, we have SME, our home loans and loan against property, as well as our personal loans business, as well as our two-wheeler business. So more or less, if you look at the disbursements over the last couple of quarters, more or less both of them have been running neck and neck. And we have had very good growth in home loans as well as in the two-wheeler business. The two-wheeler business has actually done quite well over the last 6 months. And in the home loan business, for example, post the launch of our complete home loan proposition, which is one of the sort of pioneering moves in the industry, where we have also introduced the home decor finance product in an integrated fashion, which probably we are the only lender in the market to do so. We clocked 1,000 crores of disbursements in the month of March, which was the highest ever, and again clocked about 900 crores in the month of June, which was the second highest ever. So our retail housing disbursements remains very, very strong. Our two-wheeler disbursements remain very strong, and more or less both the businesses are sort of running neck to neck. So overall, for the next couple of quarters, I do believe that we will probably sort of the trajectory will be a 50-50% trajectory. After which I do believe as our personal loans business, which we are planning to grow in a risk-calibrated fashion, sort of kicks in with a little more volume, probably our urban disbursements will outpace our rural disbursements.
Mr. Roy, just a quick word on MFI. You mentioned MFI and collections, etc., have been great. So it's about, I think, what, 30% of your AUM, but around 70% of your profits, right? So it's got an outsized impact on earnings for you. What is, is the micro MFI cycle going to remain very benign, or as we've seen in many states, as the political equation, etc., changes, there is some populism which is starting to creep in, loan waivers, etc. Just wanted a quick word on that.
Yeah, so if you look at our MFI business, we are at like close to 26,000 crores right now. And our collections sort of trajectory as well as our asset quality has remained very, very stable. And it is primarily, because of a couple of reasons. First and foremost thing, we have been very, very prudent in terms of sort of assessing our customers. Even when RBI sort of said that, you probably need to underwrite on the overall household income, we never sort of abandoned the association norms, and we kept going on with the association norms as well as the leverage norms. So that has served up us in good stead and sort of given us good asset quality on the MFI side. Again, almost close to 40% of our customers are our exclusive customers, so they are absolutely non-leveraged customers. And I do believe that though there have been some signs of leverage which has been visible in the MFI industry, the industry actually has moved fast to self-regulate. As you are aware, MFIN, the new regulations or the guardrails that MFIN and all the lenders agreed came into effect from 15 July, which actually take action on both on the leverage side as well as the association side. So I believe that the industry is cognizant of the problems that might sort of arise in case the target segment gets over-leveraged, and the industry has moved relatively quickly to address those issues on a collective basis. As regards to sort of the political sort of impact on this lines of business, as of now, though some of the waiver etc. announcements are mostly on the farm loan, especially on the on the crop loan sides, and we do believe that it does not impact our lines of businesses directly. However, I would like to point out that as an organization, we are cognizant that this line of business at sometimes might be prone to event risk. That is why we are carrying about 975 crores of macroprudential overlay just for this business. We created this sort of overlay about 2.5 years back, and we haven't dipped into this business, dipped into this overlay. And because, and we hope we will not need to, and because, our collections efficiency, our portfolio quality, and sort of our disbursement momentum in this business are well calibrated and strong, and we are confident of a good outcome going forward.
Okay, we'll let you go on that note. Thanks a lot for joining in. That's Sudipta Roy of L&T Finance talking about the business. By the